Hi, this is Jason, and today we'll talk about risk premium in the context of home insurance and motor insurance. At a high level, the risk premium is essentially the premium we would charge to a given policy if we were to achieve 100% loss ratio. So in essence, what this means is a premium that is purely claims experience based and nothing else, i.e., excluding commission, expenses, profit targets, etc. So purely claims driven premium. So risk premium is decomposed to peril level. And what we mean by this is the level at which we model at. And these are specific for home and motor, as we'll see in the next few slides. But for a given peril, what we're interested in are essentially these four components. So at peril level, we would typically model claim frequency. So this is the number of claims over exposure, and claims severity. So this is the incurred claim amount over the number of claims. And then since we're looking at varying historical data, claims data, and policy data, we need to take account of IBNR and inflation. So with the more recent years, there's likely to be claims that are still in development. So this is why we need an IBNR, incurred but not reported, adjustment in order to get to ultimate claim figures. And similarly, because we're looking at varying historical claim years, claims inflation changes over time. And since we're using past claims data to model on and applying the model to future periods, we need to take account of inflation and expected inflation. So at peril level, as mentioned, we are interested in considering these four components. And then essentially for each peril, these are aggregated up to what we have as a burn cost or otherwise risk premium if we were to charge that figure. So now we can look at the specific perils, and starting off with home insurance. As a customer, we can, for instance, get coverage for buildings, we can get coverage for contents, and similarly personal possessions. So buildings is anything structural related with the home generally, and can include, for instance, pipes, fixtures, fittings. Contents is items within the home, and personal possessions is, for instance, luxury handbag and luxury watch that you take with you outside of the home. So within each of these coverages, we have their perils. So accidental damage is a peril, fire is a peril, etc., etc. And as we saw in the previous slide, what we're interested in within a peril is to model its claim frequency and its claim severity. So we can do this for each of the peril within the coverage, and essentially at the end aggregate them up to give a coverage level risk price. As you can see, buildings and contents pretty much have the same perils in common. The only exception in this case is subsidence. So what this relates to is only buildings, because this is a structural related claim type. So for instance, you have a load of trees surrounding your home, and these trees are very deep rooted, and in the summers, especially with prolonged no rain, then it could cause these trees to suck up a lot of water, moisture, and leaving the soil pretty rough and collapsible, which can cause, for instance, cracking to the home wall, or even collapse or foundation issues, for instance. So this would be a buildings related peril. If we look at escape of water, this example could be a serious burst pipe, and over time, without knowing, this has caused more and more damage, and eventually the ceiling collapses. So this would be a buildings related claim, but at the same time, if contents is covered, and in the case of this collapsed ceiling affected, for instance, your home cinema below and all the equipment, then this would be a contents related escape of water claim. You may have noticed that personal possessions, there aren't any perils specified, and this is because it's relatively small coverage compared to buildings and contents, and maybe the data is not there. So essentially, the granularity or the way to which home insurers model risk premium really depends on the data that's available, the claims data, the granularity of the data, and also the grouping of claims um, that might have been done. So this is just an example, a typical example of home insurance perils, and the level at which um, home insurance is modeled at in terms of risk premium. So if we move on to motor insurance, we can see typically three coverages that we can buy as a customer. So comprehensive, which covers all the perils, as it says on the tin, comprehensive. We could buy a third-party fire and theft, so only third-party related claims are included, plus fire and theft. And then TPO, which is third-party only, so similarly to this one, but excluding the fire and theft. So this is a bare bones insurance coverage. So if you have an accident and it affects, say, a third party, i.e., someone's home, or you drive into someone, then only the third party only coverage concerns that only. But we can have a look at, say, theft. So this could be, for instance, keyless entry to your vehicle, and then your vehicle is driven off, stolen. So this would be a theft claim and would fall into this peril, which in this case is grouped up, fire and theft. You can see in third party only, if you were a customer and bought third party only, then fire and theft would not be covered in your insurance policy. So overall, these are the perils that are modeled at. As mentioned in the previous slides, the way at which risk modeling is done really depends on the insurer and also preference. So rather than having three sets of risk models, one insurer may, for instance, have this coverage as a factor within all the models and having one combined one and just using this as a factor rather than separately. Overall, as mentioned, these are aggregated up to give essentially a coverage level risk price for a given policy. So just to summarize, the risk premium, as mentioned, is purely claims driven price if we were to achieve 100% loss ratio. Obviously, with the risk premium, this is not the final premium. It is, but it is a very important component within the final premium, as essentially the risk premium provides a backbone to pricing. Obviously, in terms of the risk premium, on top of this, you'd have your commission, you'd have your expenses, you'd have your levy, you'd have also IPT tax, any profitability targets, any reinsurance cost consideration, etc., to essentially give your final premium that the customer sees.